Everyone always gets hung up on where to get into positions. Well, today we're taking a look at where to get out of them. Let's start off with POIs and levels. This approach involves identifying nearby points of interest, POIs, or significant levels of support and resistance, supply, demand, or just liquidity, and targeting those for taking profit. POIs and levels can be great targets for taking profits because they could allow you to capture most of the move in a particular direction before the potential for a reversal sets in. There are downsides though. Utilizing levels and POIs can introduce a lot of discretion to your trading, which can make data gathering through backtesting a bit more difficult. Also, generally speaking, if you target levels or POIs for taking profits, you probably want to stick to the closest relevant level that gives you a reasonable risk-to-reward scenario. This is also referred to as targeting the low-hanging fruit. Now let's talk about using a fixed risk-to-reward. With this approach, you determine your profit target based on a predefined ratio relative to your initial stop loss. For example, if your stop loss is 50 pips away and you're aiming for a 1-to-2 risk-to-reward ratio, your profit target would be set at 100 pips. This method helps ensure that your potential reward outweighs your risk, even if not all trades are winners. Make sure that you test for multiple risk-to-reward scenarios and expect that the higher you push your reward, the lower your win rate will drop. Some traders prefer to use a fixed amount of pips or points as their profit target, so let's talk about that. This straightforward approach involves setting a specific numerical value as your target regardless of market conditions or volatility. For example, you might decide to take profit at 50 pips regardless of whether the market is trending strongly or even ranging. While this method lacks the flexibility of adjusting to varying market conditions, it provides a clear and consistent framework for profit taking. Targeting a fixed amount of pips or points for a profit target regardless of market volatility isn't generally encouraged unless you have the data to back it up. If you want to target 10 pips or points every trade no matter what, you just have to go test for that. Lastly, let's talk about trailing stop losses. Instead of setting a fixed profit target, a trailing stop loss dynamically adjusts based on price movement. As the trade moves in your favor, the stop loss trails behind, locking in profits while allowing room for potential further gains. This method is particularly useful in trending markets where it can help you to ride the trend and maximize your profits while minimizing the risk of giving back gains during retracements. That being said, trailing your stop can knock you out of the trade during a retracement right before price takes off. It's another method to test out to see if it fits your risk appetite. Take these profit-taking tips to replay mode and get testing. Find out what works best for you and get your data. Let me know how the testing goes down in the comment section.